We also have Kaushik Das with us on the phone line, Director and Chief Economist at Deutsche Bank Research in India. Kaushik, thanks for being with us. Now, Uday Kotak has just said that if the COVID situation is as it is, expansion of the central bank's balance sheet will become inevitable. What is the space here for the RBI to do that, given that we've already seen a fairly high expansion and when it comes to advanced economies, and this is a debate that has come up here and there over the last year. What really do you feel is the optionality of doing that now?
Hi. First of all, we should remember that, RBI has already committed to its GSAP program that they would be, buying at least 1 trillion INR of government securities in April, June itself. And the market expectation is that this will be done over the next 7-8 quarters as well to support the economy. So in a way, RBI has already pre-committed to using its balance sheet. And when we are in a, kind of pandemic situation, which is once in a 100-year kind of an episode, I don't think RBI will have any problem of utilizing the balance sheet, and they have a lot of space. And what is required is to maintain financial stability and to ensure that you don't have any problem in the financial market space, either be it in NBFCs or banks, and you have sufficient liquidity, which is there in the economy and going to the productive sectors of the economy. So to that extent, we remain confident that RBI will use its balance sheet at this stage. Otherwise, there could be, a sacrifice on growth, and whatever growth estimates that we have at this stage, 10.5% for FY22, could turn out to be lower without the explicit RBI support.
Okay, what are the kind of risks to the expansion of the balance sheet as you see it? And also, given that policy normalization looks to be delayed, what's your view on liquidity management as of now?
So the normal risk that you think of increasing balance sheet is obviously whether you could have inflationary pressure building up with a lag, and whether, you could have a problem of, overheating of growth or, those kind of things. But at this moment, we don't have that kind of a problem. In fact, we have a negative output gap, which means that economy is growing much below potential. And therefore, risk of, big inflation kind of, increase is not there. Just think of it from the point of view that so many people may have lost their jobs, and, the labor market is pretty weak. So nobody will have the bargaining power to go and ask for higher wages. And therefore, we would not have a scenario where demand pull inflation would be a big risk over the next 6 to 9 months, simply because growth recovery would also be weaker than what we would have got if we did not have this kind of a second COVID-19 wave. So as long as growth is on the weaker side, we would not be worried that much about inflationary risk, from a structural point of view, and therefore RBI using its balance sheet doesn't kind of have that kind of a risk, at least for FY22. Now, obviously, if growth improves to a certain level and the vaccination drive improves significantly, and we don't have that kind of a problem, then RBI will think of, slowing down the pace of, purchases that they have promised. But that is a story for a later period. At this point of time, we are still firefighting, and we need to ensure that we have sufficient support both from the monetary side and fiscal side to support growth. So growth is a bigger priority at this stage rather than thinking about inflationary risk.
Sure. Mr. Das, how is it that you see the RBI manage the huge government borrowing? And on the other hand, what kind of bearing would it have on the movement of the yield as well as the rupee?
So if you've seen, RBI has managed the government borrowing program from last year pretty well, and 10-year government bond yields have gone up to 6.25%, but now it's kind of settled down at 6%. So there could be, pressure on the 10-year bond yields to rise as, growth recovery becomes stronger in the next few quarters. But we know that RBI has already committed to purchase a lot of bonds over this particular FY22. So earlier, Governor Das had said that RBI will buy at least INR 3 trillion of government bonds in FY22. Last year, they had bought close to 3.7 trillion INR worth of bonds. So this time, if they're doing 1 trillion INR worth of GSAP in April, June, it's expected that RBI could buy close to 4 trillion INR again worth of bonds. So we would assume that there would be natural pressure on bond yields as growth improves over the next few quarters, but RBI will ensure that those increases are orderly and you have an orderly evolution of the yield curve, and it doesn't kind of create any kind of problem for other parts of the term structure of interest rates so that growth takes a hit, at least in the initial stage of the recovery. So we would expect RBI to remain proactive with its bond purchases, and we know that the supply pressure is huge from the government side, the bonds that they're going to issue over the next several months. But given that RBI is there in the market, we think that yields will not be moving in a disruptive fashion, and RBI will manage the government program pretty well, just like they did in the last year.
Sure. What are the options and measures, Mr. Das, you think that the RBI and government would take or could take to try and mitigate the economic damage caused by the second wave?
So, there are two ways to think about it. One is the base case scenario, where the expectation is that by mid-May, the COVID-19 curve that we are seeing now should kind of peak for the whole country, and then we should see gradual recovery thereafter over the next several months. Now, thankfully, after 1st May, when we saw new cases rising about 4 lakh, we have seen over the last 2 days cases coming down. We need to wait for a few more days, at least a week, to see that whether cases across the country have already peaked or not on a total basis. That will be a very positive sign that at least the numbers are not increasing on a daily basis, and it has peaked somewhere on 1st May. And that is expected, because almost all the states in the country have announced some form of lockdown restrictions, and therefore the restricted mobility will lead to kind of overall cases coming down. Now, we would need to wait for a few more weeks to see if that is happening. So that will be the first stage. And the second stage, we would expect how quickly we can get back from that 4 lakh number of cases to below 1 lakh cases, which was the peak during the first wave. Now, so in that kind of a scenario, RBI will delay their exit strategy what they announced, and will turn obviously supportive of growth. But we don't expect any big bazooka or something in that kind of a scenario. But in the alternate scenario, where cases are not peaking by mid-May and it gets extended to, say, June, and there is more chatter about nationwide lockdown or extended lockdowns, in that kind of a scenario, we think RBI will turn significantly dovish. They will ensure that short-term interest rates fall closer to the reverse repo rate again, or even below that. There are mechanisms to do that by bringing a standing deposit facility and making it the floor, and that could be at 3%, which could be below the reverse repo rate of 3.35 at this stage. So those are like the plan B measures if they have to come. And also the fact that on the fiscal side, one positive thing is that the government has already taken a pretty high level of expenditure, and the expenditure is actually maintained at the same level that we had last year. So it's not that the government is not supporting growth in this year and the expenditure is still strong. Now, in case certain sectors or certain schemes need more support, I think the government will give that at the cost of reducing some expenditure where we can, kind of have some cost saving. So I don't think that there is a risk of that 6.8% fiscal deficit target to be breached, and government will try to manage the expenditure allocation in such a way that we maintain the overall fiscal deficit target, and you don't see the government borrowing program going up. So that's the kind of support we would expect. But I sincerely hope and pray for all of us that we don't need to think about the plan B, and in the next few weeks we should see a peaking of the COVID-19 cases, and then we focus more on the vaccination drive and see how quickly we can get back to the 100,000 new cases mark, which we had just a few months back.
Okay. Fair enough. So while most did expect double-digit growth with this wave now, any numbers you want to put to that GDP expectation going forward, Kaushik?
So again, if there is a kind of localized lockdown continuing for a few more weeks, then our forecast of 10.5% is okay because we have a very favorable base effect this year. In fact, last year, when we had given this forecast of 10.5% for FY22, Deutsche Bank was pretty non-consensus in that because most people on the street and different agencies had forecasted 12%, 13% growth. So that time we gave a 10.5% growth, expecting some bit of problem on the related to the second COVID-19 wave and vaccination issues. So all that we had already factored in 10.5% growth that we had given. So what has happened is the street, which was expecting 12% growth also or higher, and even now the IMF has a 12.5% growth, they have come down to 10.5%. So the mark-to-market has already happened based on whatever restrictions have been announced. The issue would be if you have a nationwide lockdown or extension of these localized lockdowns beyond May to say June or July, then that 10.5% could easily come down to 8%, positive, and that would be much lower than what we are thinking. So that is a problem. I forgot to mention when you asked what other things RBI can do. Obviously, there could be extension of this one-time debt restructuring for MSMEs, and that could be increased by 6 months and more time given for kind of the debt restructuring for this segment of the economy, because you would need to support the small and medium scale enterprises as much as you can so that you don't have any problem in the credit market. So that can happen. RBI can also do TLTRO kind of programs to provide liquidity to certain sectors which need the most, and special liquidity financing window for NABARD, SIDBI, National Housing Bank, like what was done last year. They also could be coming into consideration if things kind of worsen from here.
Okay, Mr. Das, great to have you on the show and get in all that insight. Good speaking with you.